sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, markets climbing on rate cut optimism. Oakmark's Bill Nygren on three great companies whose stocks are surprisingly cheap. And later, high mortgage rates are hitting the housing market hard, and the Fed's presumed rate cut next week may not be a quick fix. We'll break down why. But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Ali Coram, and Andrew Berry. So, Ben, last week we wondered out loud, could the AI trade be dead? Mr. Market gave a very firm answer this week that it is not.
Oh, it is not dead. Oracle came out with earnings on Monday afternoon after the market had closed, said some nice things about how AI was still live, it was going to spend a ton of money, and that was all the market needed. NVIDIA was back. I think it was up close to 16% this week. Semiconductor stocks were up about 10%. It was just a fantastic week for tech generally, but it was also a pretty good week for all the other stocks, too. I think about 390 of the S&P 500 stocks were up this week. That's partially because of optimism around the Fed. But when you step back, Magnificent Seven were up about 7%. The NASDAQ was up about 6%, had its best week of the year. S&P also had its best week of the year, up 4%. The Dow brought up the rear 2.7. It was a great week, except for a tiny little hiccup on Wednesday after the inflation report.
So, Ali, we are graced by your presence, a special guest from Investors Business Daily, our sister publication. And you really look carefully at the charts. So what were the charts telling you as that action was happening that Ben was discussing?
Exactly. What a 180 from the first week of September, right? And things really kicked into high gear on Wednesday. We saw an outside day upside reversal, and that is very powerful, a bullish signal, meaning the low and the high of the day totally engulfing the prior day. So the S&P intraday was down 1.6% on Wednesday, but came roaring back, closing up with a 2.5% swing by the end of the day. So that was a momentum shift. Absolutely. And your expectation is to see continued strength, and that's exactly what we got Thursday and Friday.
Momentum at a reasonable price, as you guys call it. Mark. So, Ben, now we got the Fed set up. What do you see happening next week?
Well, if you had asked me this a couple of days ago, I would have said the Fed's going to cut rates by 1/4 point. But then we got a story in the Wall Street Journal from Nick Timrose, who's kind of seen as the Fed whisperer, talking about this uncertainty around whether it'd be a 1/2 point or 1/4 point. And now the odds are of a coin flip. And so we really don't know. We know we're going to get a cut, but whether it's going to be that 1/4 point or 1/2 point, that remains to be seen.
Yeah, I'm in the 1/2 point camp. I don't know why the Fed doesn't go a 1/2 point. The short-term rates at almost 5.5 are an outlier now, with most interest rates under 4%. Given where inflation's running under 3, I think there's no reason the Fed can't get can't do 50 basis points and get the short rates about 4% in the next 6 months.
Yeah, see, Andrew, I agree with you on all that. The one thing that makes me think maybe not is that the history of 1/2 point cuts is not great. Usually it's a sign of a recession, and usually the markets sell off, and I think the Fed knows that, and I'm wondering how they would explain it. So it's going to be very interesting when we get the rate cut on Wednesday.
One way or the other, rates are going down, Ali. Barron's got a story coming up this weekend about how you ought to be investing in stocks in that falling rate environment. What are you seeing there?
So I think the key is going to be what's the market reaction next week. We know a cut's coming, how big, but at the end of the day, what's the market going to do? Are we going to need to lean more bullish or bearish? I think if you gave me the headlines ahead of time, I'm still not going to know how to trade it. So with that being said, I think we should look at stocks like Royal Caribbean. This is a cruise line, of course, and in a low rate environment, that's great for shipbuilding. I like buying stocks in uptrends close to key moving averages, and a lot of technical traders look at the 50-day line. So Royal Caribbean's about 5% above the 10-week line, really snapping back from the prior week. So I think it's in an ideal setup.
Also, when central bankers get dovish, gold bugs get bullish. What do you see there?
Yeah, there's definitely an inverse relationship between bonds and golds. And so when you see yields falling, and I think actually investors now are already anticipating next week, you see gold outperforming not only this week, but if you take that step back, all year long, especially starting in July. So one way to play it is with Newmont, a gold miner. So pulling back to its 10-week moving average, another technical level we like to look at, seeing a strong bounce from there. So one to watch as well.
Yeah, and gold hit a new new high on Friday is over $2,600 an ounce, up about 25% plus this year, beating the S&P 500.
Andrew, back in July, there was a debate between Donald Trump and Joe Biden. Some people are aware of that. Disaster for Biden. You came on the show and reported on some of the Trump bounce that we saw in the stock market. This week, different story. What'd you see?
Well, I mean, it looked like that Kamala Harris was pretty much the clear winner. You saw the odds of her winning the election rise on some of the betting sites. And so she's now a slight favorite to win it, even though the polls are somewhat mixed. You saw strength in green energy stocks, which would benefit from another 4 years of a Democratic administration. There's a First Trust green energy ETF that was QCLN, up about 6-7%. Some of the renewable energy oriented utilities like AES and NextEra were higher. And you saw some weakness in the managed care stock, Humana, which might be a loser if you get another 4 years of the Democrats in the White House.
Gotcha.
Yeah, but there's a big difference, I think, between this reaction and what happened after the first debate. Then we had a really sustained trend in some of these stocks that would benefit from a Trump presidency because it looked like we were going to get that Trump presidency and perhaps a Republican sweep. This time, we had a bounce. I think it was mainly some short covering, and it didn't follow through, and that's a very big difference.
And all of this will change 16 times before November 5th. Thanks, guys. Markets heading higher as investors expect the Fed to cut rates next week. Oakmark Fund portfolio manager Bill Nygren on where to put your money next. Stocks up for the week, fueled by renewed optimism that the Federal Reserve will cut rates next week, but the market is still dominated by a few mega-cap tech companies. Here now with where to find value opportunities is Oakmark Fund portfolio manager Bill Nygren, a real veteran of the market. Thanks so much for coming by the studio, Bill.
Thanks for having me, Jack.
So you've long been known as managing an eclectic portfolio. It was called a value fund, but you had a lot of names that some people thought, wow, that's a growth name. Over recent years, your portfolio from a PDE, from a price to earnings ratio perspective, has come to look more and more like value. Now you're way below the S&P 500, I think 11 or 12 times earnings. I suspect you're going to tell me it's the index that's changed, not Bill Nygren.
Right. At Oakmark, we've always had maybe a more inclusive view of value than a lot of our peers have, and trying to identify what a business is really worth as opposed to just a simple PE ratio or price to book ratio. And as recently as a couple years ago, when the growth stocks were down so much in price, it was leading us to some growthier names in the tech sector. But as those names have come roaring back, our portfolio now looks very much like a traditional value portfolio. So we aren't doing anything different. What's changed is how the S&P has become so dominated by a handful of megatech, rapid growth technology companies.
And I think you told me that in your fund, you would never have more than a 4% weighting in any given stock because that is seen as risky. If you own the S&P 500 index, you're well over that with, what, 5 or 6 stocks?
Right. It is kind of funny. People sometimes think of Oakmark Fund as being a risky fund because we're invested so differently than the S&P. But the S&P now is as concentrated in technology as our fund is in financials. And our largest holdings, we've always thought 4% was a pretty good cap for an individual, that they shouldn't have more than 4% of their assets in any name. And I think right now there are 4 or 5 S&P 500 names that are significantly more than that.
Let's talk about 3 companies that are in your portfolio. We talk about all of them, but we don't have time. 3 very different ones. Let's start with GM, below 5 on its price to earnings ratio, and a company that some people worry might have missed the boat. You're a fan.
Yes, we really became a fan of this company when they radically altered how they were redeploying the cash that they were earning. Up until about a year ago, GM had been reinvesting that capital, trying to grow in adjacent businesses. And this past year, they switched to entirely returning that to shareholders. They announced an accelerated share repurchase plan of 20% of the company. And once that was completed, they've continued to buy back, taking out well over a quarter of the shares of the company this year, and we expect them to continue that if the investors don't respond by acknowledging the higher value of a GM share.
Let's shift to Alphabet. You're not a big Mag 7 holder. You do hold that company, and you think that 20, was it 19 or 20 PDE actually really overstates the price of that stock?
Right. Something that Alphabet has been doing for years is they have what they call other bets, essentially venture capital investments. If they made those through a venture capital firm, they'd go on the balance sheet as assets. But when they do it themselves, the cost goes right through the income statement. So we add back those losses, and after we adjust for that, we think you're buying the search business, Google and YouTube, for about 13, 14 times earnings. And I think it's pretty hard to argue that Alphabet deserves to sell at less than 2/3 the multiple of the S&P 500.
And they could get broken up, I guess. Unlikely, could happen. There's also legal threats, but I know you think that if they did get broken up, it might even unleash value, right?
Right. One thing breakups always do is it forces investors to individually value each piece of the company. If they trade separately, they have to have a value. And our whole argument is when you add up all the pieces, Alphabet is worth significantly more than it's selling. So it might not be in the best real long-term interest of the company to break up, but we think it would increase the price if they had to do that.
We're almost out of time, but I promised 3 stocks, so we'll get to Corebridge, an insurance company.
Spinoff from AIG, primarily in retirement services and insurance. They don't have much in variable annuity. Their assets and liabilities are well matched. 5 times earnings, 60% of book value. We think it's a well-managed company.
Certainly a cheap stock. There are no bad assets, only bad prices, is how our box says. Thanks a lot, Bill Nygren. Appreciate it.
Thank you.
A Fed cut is on the table for next week, but don't expect a lower rate environment to fix the housing affordability crisis just yet. We'll break down what it means for home buyers and the housing market next. Homeownership still out of reach for many Americans as mortgage rates remain high, and would-be buyers won't see much improvement on affordability from the Federal Reserve or from campaign proposals floated by Vice President Kamala Harris or former President Donald Trump. It's Barron's cover story this week, and we've got Barron's managing editor Darren Fonda here to break it all down. Darren, good to see you again. Thanks for coming on.
Thanks for having me.
So I'm old enough to remember 15 years ago when you didn't need an income, you didn't need a down payment, houses were selling very easily. What has changed?
Well, things really changed during the pandemic when the Fed cut rates really sharply. The housing market took off, sales took off, a lot of people bought houses, and then it all kind of collapsed when the Fed raised rates really sharply. That left prices really high, and a lot of people shut out of the market. They couldn't afford a house anymore. Inventories have not recovered, and that's pretty much where we are today.
Yeah, and that's the situation with me. Look, I bought a home in 2020.
Good for you.
Raleigh, thank you, in the Raleigh, North Carolina area. So a great monthly payment, super reasonable, and I have all this home equity. But in terms of a lateral move, say if I wanted to move an hour away, even a lateral move is basically double the mortgage. So for now, I'm not budging.
Well, you know, I mean, there's been a lot of gloom about just how first-time home buyers are suffering. But, I mean, for the average American homeowner, I mean, it's been a boon, the 30 to 40% increase we've seen in home price in the last couple of years. It's really fattened home equity. I mean, if you bought a $500,000 home, it's now worth $700,000, and the equity in your home is up a lot.
So it's true, but we're also locked in. I've got a great rate. I don't want to move. Darren, how do we get out of this housing gridlock?
Well, there's really no quick fix. About 40% of homeowners are sitting on mortgages below 44%, so they don't really have great incentives to move. There are some political proposals out there to incentivize development, and Kamala Harris is proposing $25,000 in grants for first-time buyers. What really needs to happen, though, is that housing prices would have to come down sharply. Household incomes would have to rise sharply, upwards of 50%, and mortgage rates would have to come down to like 3%. None of that is remotely likely anytime soon.
So, Andrew, take us into the markets. You were bullish on housing stocks a couple of years ago. That was a great call, but they've really run far. Do you still see upside there?
Well, I mean, the home building stocks have been among the strongest groups in the stock market this year. I mean, the industry leaders, D.R. Horton and Lennar, are up 30%. Toll Brothers is up closer to 50% or so this year. And I think they're benefiting from a number of factors, including they're better managed, they've got great balance sheets, and they're taking market share. The stocks, though, may be a little bit extended right now. They're trading at a little bit higher than average multiples right now. Lennar and D.R. Horton around 13 times earnings. These stocks often traded under 10 times.
Yeah, a little stretch, but I actually like momentum. So if you run a screen for momentum plus reasonable PE, there are a lot of home builders in that scenario. So in addition to the ones you mentioned, we also have KBH and Pulte Group and Green Brick Partners. And I'm seeing rebounds off of the 10-week line this week. This is another area seeing momentum and outperformance in anticipation of the cuts next week.
And then the other option is you could just go buy a couple ETFs. There are two that stand out. The Spider S&P Home Builders ETF, that's XHB. It actually leans towards the home building stocks. And then you have ITB, which is the iShares U.S. Home Construction ETF. It has a mix of things. So it has the home builders, plus it has some retailers like Lowe's and Home Depot and other stocks that are housing adjacent.
So, Darren, we're talking about the housing market as if it's monolithic, but actually there are a fair number of regional differences. What are you seeing out there?
Well, I think the places where we're going to start to see affordability improve a little bit and supply improve a little bit is probably in the Sun Belt. We're seeing some softening in markets like Texas and Dallas. The Sun Belt tends to have more favorable zoning and regulations for developers, but there's still a huge backlog and shortage of houses that need to be built. There's estimates out there for 7 million houses that would be needed to plug the shortages over the next few years, and builders are only putting up around 850,000 a year, so we still have a long way to go.
Yeah, I mean, anecdotally, you're hearing about weakness in some Sunbelt markets like Tampa, which have been very strong. I follow an economist at the Dallas Fed, and she's been talking about a lot of inventory in the Dallas area right now, and even Austin, which has been a hot market, is cooling off.
Darren, before we go, one question for you. The housing market not only affects everybody's lives, it has an effect on the macro economy because it's such a big part of all of our budgets. Do you see danger there for the economy?
I don't know if I see danger there. I mean, I think, people are sitting on a lot of home equity gains after such, big increases in prices over the last few years. There's a huge wealth effect to that. If you have a mortgage that's under 4%, that's like putting free money in your pocket right now compared to today's rates. And that can support a lot of consumer spending, home furnishings, purchases. So if the economy deteriorates, we would see housing go back down a bit. But they're very closely intertwined, and housing is, not going to be the thing that drags down the economy right now.
All righty. Thanks, Darren. Williams-Sonoma stock popped on Friday. Maybe people expect a lot of those purchases for this. Meanwhile, Ali and Ben have a pair of investment ideas, and Andrew predicts what companies may be next to join the S&P 500. Stay right there. Andrew, 3 new members were added to the S&P 500. Who are they? And more importantly, what does the Barry crystal ball say will be the next 3 to join?
Well, the S&P adds about a dozen companies every year to the S&P 500, which is the ultimate stock market club. It's even more important than the Dow Jones Industrial Average. Every up-and-coming company wants to get in. And the latest additions were Dell Technologies, Palantir, which is in the software business, as well as Erie Indemnity, which is a little-known but very well-run insurer. The issue now is who could be next, because stocks often get a pop, as Palantir and Dell did when they were added this week. I think the 2 of the more likely candidates are Apollo Global, the alternative asset manager, which is right behind KKR and Blackstone in that business, which are both in the S&P 500. Another potential addition is Workday, the software company. I'd also point to Coinbase, which is the crypto brokerage firm, as well as Ferguson and Plumbing Supplies.
Alrighty, so there's no guarantee that joining the club is actually good for your stock. There's that pop kind of in anticipation, but some companies have done worse when they joined than the companies that were booted to make room for them.
Well, Supermicro was added this past year. The AI plays down about 50%. And Tesla is actually little changed since it was added a few years ago. But in the long run, companies often do very well, like NVIDIA, which actually replaced Enron about over 20 years ago, up more than 100-fold since then.
Enron didn't do so well, but Alcoa doubled after getting kicked out of the Dow, so you never know. Ali, let's go to actionable ideas, the great Barron's tradition. What's yours?
I like Arista Networks. This is an artificial intelligence play in the computer networking space. They have a very close relationship with Meta. The stock is up over 50% this year, but it's trading within 6% of the 10-week line. So I think you can use a decisive close below the 10-week as your stop.
No connection to the Arista record company, right?
Yeah.
Ben, what do you have for us?
Well, I'm going to stick with the housing theme. I'm looking at Builders First Source. This is one of the best performing stocks over the last 10 years. I think it's averaged about 39% annualized. They basically sell stuff to contractors. Anything a contractor needs for renovations, to build a house, they provide it. And it's been a great business for them. They do it very well. With rates coming down, there are going to be more renovations, more homes built, and that's going to be great news for Builders First Source. It had pulled back. It does this periodically, and right now it looks like it's getting ready to get that uptrend going once again.
And if you don't like the prices you're paying to contractors, maybe you make a little money by buying the picks and shovels.
Yeah, why not?
All right. Thanks, Ben. Thanks, guys. To read more, check out this week's edition at barrons.com. And that's all for us. We'll see you next week on Barron's Roundtable.